Let's dive into the big story of 2025, the crypto crash. The year began with crypto prices soaring, especially Bitcoin, which hit a record $126,000 in October. But then, the market crashed hard. Bitcoin lost 36% of its value in weeks, and as of December, it's still down 30% from its peak. The excitement vanished overnight, replaced by panic and caution. Altcoins fell even harder, and headlines were filled with stories of massive losses. Investors, from individuals to big companies, were forced to face crypto's wild volatility. The crash was a wake-up call. Fortunes can change in an instant. It wasn't just a bad day for Bitcoin, it was a reality check for the entire industry. Was this the end of the crypto dream, or just another cycle? The crash forced everyone to rethink their approach. The days of easy money and blind optimism were over. Now survival meant adapting to a new, more unpredictable market. The lesson? In crypto, nothing is guaranteed. After the crash, caution swept the market. The reckless all-in attitude was gone, replaced by careful, strategic thinking. Investors started asking tough questions. How do I protect my money? What are the real risks? Diversification became the new mantra, spreading investments across different assets instead of betting everything on one coin. Actively managed strategies gained popularity, with professionals guiding portfolios through the chaos. People were willing to pay for expertise to avoid repeating past mistakes. The focus shifted from quick riches to building long-term resilient positions. Investors became more educated and less swayed by hype. The market matured, demanding substance over speculation. This new discipline is making crypto stronger and more resilient. Wisdom, not just bravery, is now the key to surviving in crypto. Investors wanted safer ways to access crypto, and the financial world delivered. Spot ETFs let people invest in Bitcoin without the hassle of wallets or security keys, just buy shares on the stock market. This opened the door for mainstream investors and brought new money into crypto. More advanced tools like options and futures let experienced investors manage risk or speculate on price moves. These derivatives act like insurance, protecting portfolios from sudden drops. You can also invest in crypto-related companies, miners, tech firms, and infrastructure builders for indirect exposure. The variety of investment vehicles, from simple ETFs to complex derivatives, signals a maturing market. Investors now have real choices about risk and strategy. The days of buy and hope are fading. The market is evolving, offering tools for every type of investor. This diversity is a sign of crypto's growing sophistication. The toolbox is bigger and smarter than ever. Some companies went all in on Bitcoin, turning their cash reserves into crypto. Strategy Inc. and Metaplanet became famous for this bold move, with their stocks soaring as Bitcoin climbed. Investors paid huge premiums for these shares, betting on endless growth. But when the crash hit, these stocks fell even harder than Bitcoin. Strategy Inc. dropped 54%, while Bitcoin lost 36%. The risk was double exposure to Bitcoin's volatility and the company's own business challenges. The premium vanished overnight, exposing the dangers of tying a company's fate to a single speculative asset. What seemed visionary quickly turned risky. Shareholders demanded answers as losses mounted. The lesson: direct ownership or regulated ETFs are safer than risky corporate proxies. The experiment was bold, but the crash revealed its flaws. In crypto, shortcuts can be costly. The crash hit crypto miners hard. Profits evaporated as coin prices fell. Mining became unprofitable, with electricity costs outpacing earnings. Instead of folding, smart miners pivoted to AI. Their massive computing power was perfect for training AI models, which need huge processing resources. Companies like IRN, CleanSpark, and Riot began transforming into AI data centers, renting out their hardware to tech giants. This move diversified their business, reducing dependence on crypto's volatility. The AI boom offered a new lifeline, blending digital assets with cutting-edge tech. But the transition isn't easy. New hardware, big investments, and stiff competition await. investors are watching to see who can pull it off. The winners could dominate the next decade, the rest may fade away. The pivot to AI is risky, but it's also a shot at survival. In tech, adaptation is everything. The shift from crypto mining to AI data centers reveals a deeper connection. Both industries rely on massive computing power and drive global demand for energy and chips. The US faces a huge data center power shortfall. Crypto miners could help fill the gap by repurposing their facilities. This synergy is crucial for the AI revolution's infrastructure. AI, in turn, can make crypto smarter, analyzing markets, detecting fraud, and optimizing mining efficiency. The two fields are merging, forming the backbone of the next-generation Internet, or Web3. Investors are seeking companies that straddle both worlds, seeing unique potential at this intersection. The convergence of crypto and AI is creating a powerful new investment theme. Their futures are now linked, sharing needs for power, hardware, and innovation. This partnership could define the next era of technology. The narrative is shifting. Crypto and AI are building the future together. The days of buy and hold are fading in crypto. Active management, where professionals make strategic moves, has taken center stage. New funds like the VanEck On-Chain Economy ETF have outperformed by being selective and defensive. Managers avoided over-leveraged companies, protecting investors during the downturn. Activist investors like Eric Jackson use options strategies to generate income and buffer losses. Selling options provides steady yield, reducing risk even in choppy markets. This approach marks a shift to smarter, more sophisticated investing. Expertise now matters more than ever. Investors want strategies that manage both upside and downside. The market is maturing, demanding professional management. Crypto investing is entering a new era, one where skill and caution lead the way. The Wild West is giving way to strategy. Despite the crash, big institutional investors are doubling down on Bitcoin. University endowments and sovereign wealth funds are quietly building positions. Harvard's endowment is now a major holder of BlackRock's Bitcoin ETF, a huge vote of confidence. This isn't speculation, it's a strategic long-term allocation. Sovereign wealth funds from Luxembourg, Abu Dhabi, and the Czech Republic are also investing. Their involvement signals Bitcoin's arrival as a legitimate global asset. Bitcoin is becoming digital gold, a store of value for individuals, corporations, and even countries. Institutional backing has helped Bitcoin hold its ground while smaller coins struggle. The big money is choosing Bitcoin for its security, decentralization, and brand. This support brings stability and legitimacy to the market. The long-term belief in Bitcoin's value is stronger than ever. Step back, and it's clear, crypto is growing up. The chaos of 2025 accelerated its transformation from Wild West to mainstream finance. Regulated exchanges, secure custody, and sophisticated investment tools now define the market. Investors demand transparency, security, and accountability. Regulators are setting clearer rules, fostering stability and growth. The industry is attracting serious professional investors. The days of anonymous founders and hype-driven launches are fading. The foundation for $1 trillion market is being built. The crash forced smarter strategies and tighter risk management. Crypto is now part of the global financial system, with major institutions backing it. It's still volatile, but it's more robust and mature than ever. The wild ride continues, but now the car is built to last.